What's up, you guys? This is Garrett Terrell. Welcome back to my channel. And in this video today, I'm going to show you the top mistakes that brand new real estate investors make and how to avoid them. So let's jump right into it. So first, I just want to preface this video by saying if you're a highly detail-oriented person, then this video is probably really good for you because I'm going to help you save as much money as possible and help you avoid costly mistakes that can literally cost you tens of thousands of dollars whenever you're buying an investment property or a multifamily property. So let's jump into the very first one. So the first costly mistake that brand new real estate investors make all the time is lack of research. And basically that means you're just blindly jumping into a deal. You're not looking at the market. You don't know the current trends. You don't know if rent is going up or if rent is going down. You don't know of any major employers in the area. You don't know what's happening with the current trends in the area as far as rent growth, as far as property growth, as far as anything. You're just blindly jumping into a deal without looking at any of this data. This is very, very crucial data that you need to look at whenever you're investing into a deal, because when you're investing into a specific property, you're also investing into that local area. So as a new investor, you want to make sure that you are looking at rental reports and how the rent is growing in that area, or if it's stabilizing, or if it's actually decreasing in some areas. You want to look at that stuff. You also want to look at population growth. You know, if you're buying into an area that is a declining population, that's not usually a good thing. And it means that employers are probably leaving the area. And so a way to avoid this is to really start networking with other experienced investors in the area. That is probably the quickest way to success whenever you're analyzing a new market or a new city or a new area to invest in. That's like going straight to the source. And in my opinion, that's probably the best route for this. If you can't do that, then you can actually look on Google. You can look at market reports, trends, real estate blogs, stuff like that. That's just going to put you that much further ahead whenever you're analyzing a real estate deal. So the second big mistake is overpaying for properties. Now, as a brand new real estate investor, you're not going to be well versed in what the values are in the area. And you get all excited just because you see the dollar signs. You think, oh, if I buy it for this price, I can just make X, Y, Z, and it's all going to be great. And sometimes you don't have that awareness to actually take a step back and look from a third-party perspective. Am I paying too much for this house or this multifamily property? Even though it's a good deal, am I paying too much? Are there other comparable properties in the area that are at a similar price or even at a lower price? Or am I actually getting a really good deal and all these values in the area are way up and I'm getting this deal for 10 or 20 or 30% under market price? So that is a huge lesson to learn in this business, is to not overpay for properties, because when you do overpay for properties, it significantly reduces your ROI. And as we're in an environment right now where the interest rates are a lot higher than what they normally are, you definitely want to be overly cautious when you're buying a property and make sure that you're not overpaying for it, because the values are typically correlated with the debt market. So if you're overpaying for a property and the debt goes too high and people can't afford it, then your value actually might decrease, and that's when people can get into trouble. So again, just make sure you're not overpaying for a property. Make sure you can find at least 3 to 5 comparable sales in the area within a quarter-mile radius of the house to support the price that you're buying it at. So the third mistake is understanding repair costs. And unfortunately, this is just something that you have to go through to really get a firm grasp on how much things are going to cost and how you can expect to underwrite these repair costs in the future. Once you go through this 5, 10, 20, 30 times, you start to build a muscle for understanding what things are going to cost, because you get multiple bids per project. You start to get kind of an idea of what flooring is going to cost, what paint is going to cost, what countertops are going to cost. You start to get an idea of this. But when you're a brand new investor, you think everything's going to be cheaper than what it ends up being. And you kind of underestimate your rehab costs whenever you're looking at a house. If a house that really needs about $40,000, $50,000, sometimes brand new real estate investors are like, oh yeah, we can just paint, put flooring in and countertops and everything. It's going to be great. And we'll get out with 15 to 20,000. 99% of the time that does not happen. And my recommendation is, when you're trying to understand repair costs, is get at least 3 bids from different contractors, okay? Once you get these 3 bids, that's going to give you an idea of kind of a range of where this project cost needs to be at. And over the course of time, you always want to get new bids, even if you're comfortable working with a GC. Even if you have a GC and he's done 5, 10, 15 projects for you, you want to make sure that you're constantly getting bids, because as time goes on, sometimes your GC will check you on price and he'll increase and he'll do this and do that, just to keep everybody on the same page and making sure that you have the best price possible. It's always safe to say to get 3 bids from contractors whenever you're doing a job. And now the best way to overcome this is whenever you're underwriting a deal, you want to make sure that you're overestimating 10 to 20% on your rehab budget. So let's say, for example, if you truly believe that it's going to be a $30,000 remodel, then you probably want to estimate about $35,000 for that remodel, because things are going to take longer. The materials are going to take longer to get, and they're probably going to be more expensive. The contractors are probably going to be more expensive. The contractors are probably going to do the work, and there's going to be some mistakes on their work. And for them to come back and correct their original work, you're probably going to have to pay them a little bit more money. So again, do not be optimistic on the rehab budget. You always want to budget for at least 10 to 20% above your estimated project cost to truly understand repair costs when you're buying or holding or flipping or whatever it is. So the 4th mistake is poor property management and not knowing how to manage your properties, and just completely relying and giving all of your trust to a third-party property manager and thinking, oh, I have a professional company, they're just going to do everything for me and I just get to sit back and collect all this money. That is not going to happen. So in my experience, when you're hiring a property management company, you have to have clear expectations on what you, the landlord, expect and what they should be doing as the property management company. You have to ask all these questions from the start, because once you're 3 to 6 months into the deal and they're managing your rental and you start to have problems, a lot of these problems can be alleviated in the first couple weeks when you're starting to work with them. And part of being a landlord that hires a third-party property management company is you have to manage the managers. And this was a hard thing for me to understand at first, because I thought they're a third-party company, they know what they're doing. I don't really have to check in with these people. I don't have to set them to a certain standard. But the reality is that this is your property, you own it, and you are hiring these people to do a job for you. And sometimes people get that misconstrued and think, oh, they're actually managing everything for me, and I have to succumb to what they're saying. It's actually the complete opposite. You always want to make sure that you're always on the same page. There's no hidden costs. There's no hidden fees. The properties are being maintained and taken care of, and their contractor bids are also in line with what your contractor bids are saying, because sometimes property management companies hire their own contractors at a discounted price and charge you as the landlord at a market price. So again, you want to make sure that the contractors that they're using, the vendors that they're using, the tenants that they're renting your property to are all fitting within your own guidelines, and you're not just completely giving all of your trust and property to a third-party management company. It takes a team effort even when you have a third-party property management company. Now, the 5th and final mistake is probably the biggest mistake of all of them, and this is where you can really get into trouble as a real estate investor, or even as a new real estate investor, and it's your lack of exit strategy. So I want to explain this. Whenever you're buying a deal, you should always have the intention of exiting the deal even before you buy it. You always want to have some type of exit strategy in mind, just in case things get bad and you need to sell the house, or you need to refinance the house if you have bad debt. So obviously there's a lot of risk and there's a lot of things that can go wrong in real estate investing. And when you don't have an exit strategy, you're really handcuffing yourself, because especially when you're buying a flip, you're kind of thinking of the exit strategy from the start. I mean, that's pretty self-explanatory. You want to buy it at a discount, remodel it, and then sell it for a higher price. I think we can kind of all understand that. But this is more so geared towards the rental property investors that are buying a rental at a certain price, expecting the cash flow on that price that they bought it at, and then potentially in the future sell it at a higher price. So you want to have multiple exit strategies. Same thing as if you're buying a rental. You want to make sure that you're buying it at a flip price to where you can actually remodel the house and refinance the property and do the BRRRR method and keep it as a rental after the fact. You want to have multiple different exit strategies from the start, because if you're just focusing on doing a flip on the house and let's say the market turns, for example, and drops 10% or 20%, is your ARV going to be there? And are you going to be able to sell the house and still make a profit, or are you going to lose money? And that's why you want to make sure you have multiple exit strategies from the start, because you don't want to pigeonhole yourself into a deal and get stuck with it for a longer period of time than you needed to. Whereas if you bought it at a steep enough discount, you would have 4 or 5 different exit strategies of how to get out of the deal. Not only get out of the deal, but sell the deal or refinance the deal, get your money out of the deal, and make sure that you can actually profit and move on to your next investment where you keep doing that same strategy. And so lastly, I'll leave you guys with this, and this is just a great overall strategy and mindset to have when you're real estate investing, is to be more skeptical than optimistic. And that doesn't mean you don't be optimistic at all, because you have to have some level of optimism in order to make a decision and actually pull the trigger and buy a deal. And I'm not saying don't be optimistic. That's not what I'm saying at all. But what I am saying is you have to question everything when you're real estate investing. Question the home inspector, question the lender, question the mortgage company that you're getting a loan through, question the hard money company if they can get better terms for you, question the listing agent and the seller if you can get a better price, or why they're selling the deal, why they bought it originally, how they came to their price. You have to ask people questions constantly, because if you don't ask these questions, 99% of the time, people will just take advantage of your optimism. And you don't want to be taken advantage of in real estate. You want to be in the power position, and you want to be the one asking the questions, and you want to have the leverage. So that's just the biggest piece of advice that I would give to you guys, is always have the leverage, be in the power position, ask the right questions, and really get the most information out of people and really figure out what the true scenario is. Because if you just take people for their word, you'll get taken advantage of in this business. If you just believe everything that a seller or everything that a listing agent or everything that a lender is going to tell you the first time you ask the question, it's probably not the truth. And even if they are telling the truth, there's probably a little bit more to the story that could help you in your decision making. So again, a huge piece of advice. Those are the top mistakes that brand new real estate investors make. Thank you guys for watching the video. Let me know in the comments what you'd like to see in the future, and hope you have a good rest of your day, and thanks for watching.